Good afternoon, guys. Welcome to the 23rd of June. Our objectives for today, we're going to start off with fundamentals. So we're going to talk a little bit about Greece, we're going to talk about the Bank of England, and then have a look at the German and French PMIs. We're then going to move on to a few trade setups. Okay, today is going to be a little less fundamental, a little bit more technical, so take some notes. Okay, so we're going to start off with the Stoxx 50. Okay, yesterday we got a fundamental gap, today we've got a technical gap. We're going to go over the technical gap, we're going to watch the video again, all right, and then we're going to compare the two. All right, we're then going to move on to the durable goods. I'm going to show you what a rejection or a data rejection trade looks like. Okay. More importantly, I'm going to take you one step back and tell you why it was I thought we would get a rejection type data piece today. Okay. So I'm going to show you something that was in the charts that hopefully you can use for next time. We're then going to talk about the kiss of death. We spoke very briefly about this yesterday. All right. I'm going to revisit the US 10-year, and I'm going to show you now what we want to see in terms of price action as this trade plays out. We're then going to move on to the euro dollar. Okay, we're going to talk briefly about what happened yesterday. Okay, we're going to talk about what happened today and then some ideas going forward for the rest of the week. Our quiz question, what trade strategies do we use when institutions step into the markets? Okay, so hopefully you can answer that by the end. If not, I will answer it for you. So let's move on to Greece quickly. Okay, so first thing I will note, and as John says, I think he pointed this out quite nicely a little while back, was he said, it's almost a case of when the market goes quiet on Greece, that's when you know a deal's actually being eked out. Okay, the commentary or the kind of the feeling that you're getting from the commentators now is that less than a week ago it was all about, you know, Greece is going to get, you know, default and we're not going to give them anything, and the Greeks were like, well, we're not going to give anything more. Okay, all of a sudden, you know, the weekend came and now the commentary is different. Okay, it's almost a case of we're getting closer to a deal. All right, Greece is saying and doing the right things. We're not quite there yet, but you can almost see that it's changed. The sentiment towards a Greek deal has changed in terms of the commentary. All right, and more importantly, you can see that in the price action. You can see how European equities are performing. You can see how the bond markets are kind of, you know, not holding that bid anymore. Okay, so make sure you understand that. You know, when, you know, the sort of the feeling around Greece now is that we are heading towards a deal. Okay. Don't forget that, because in your strategy tomorrow, when you come in tomorrow morning, you need to factor that in. You need to factor in the idea that European equities are going to keep outperforming so long as we're getting towards this deal. Okay, and we'll talk a bit briefly about that in terms of, you know, buy the dip type strategy going forward. Okay, so effectively Greece overnight we got IMS Lagarde. She basically said we're short on time. Okay, long on, in other words, a lot of work to do, short on time. New proposals are still short on everything that should be expected. Okay, so in other words, remember the IMF does make up, you know, 50% of effectively the bailout. So they are the biggest institution or the biggest of the three, you know, people that are, or parties that are affected. Right, so very important if you hear anything from IMF's Lagarde, anything about, you know, we're not happy, no deal, anything like that. Okay, that's going to be market moving. Right. Then EU's Tusk. Okay, he says sees new energy in talks and everyone is committed to finding a solution. Okay, so from a week ago where, you know, we're not going to back down for Greece to now suddenly, all right, we're seeing energy. People are starting to react and respond. Okay, and then EU's Juncker. Now is not the time to talk about debt relief. Capital controls not discussed. Okay, very important, guys. They didn't discuss capital controls. All right, and he reiterates he thinks a deal will be reached this week. Okay, another important figure in the European Commission that's effectively saying we do think a deal is on this week. Okay, Merkel, all leaders back commitments to get a deal. All right, so this is probably the biggest, most influential person in Europe. She's saying intensive work is needed, time is short, financial sustainability is part of the talks. Okay, financial sustainability. In other words, can we give Greece a debt haircut? Can we give Greece an extension so that it's sustainable into the future? Okay, so what we're actually starting to hear, you've got to remember, guys, Merkel can't come out and say, oh yeah, no, we're going to give Greece a 6-month extension. Okay, because all of this is being debated. It's going back and forward. But read between the lines. What she's saying is that effectively, financial sustainability is part of the deal. In other words, we're going to give them some form of a deal where they get an extension or a haircut. All right. Then wants leaders on Thursday to have a decision from the Eurogroup on Wednesday. So in other words, we've been given, by Merkel, we've been given our timeline. She wants a deal from the Eurogroup tomorrow. The Eurogroup meets for an emergency meeting. So don't be surprised if tomorrow afternoon the markets start to respond. Don't be surprised if you come in tomorrow and the markets are very quiet, whipsaw, unable to rally in either direction, waiting for the outcome of the Eurogroup meeting. Okay, so important, guys, as traders, know when there are risk events in the market. Don't be a blind bat. Too many traders come in and they go, oh, I've got this setup, it's a wonderful little bullish candle, and what they forget is that candles can be created by computer programs. Okay, about 80% of what you see is all created by computer programs. What is important is when something is created by institutions, by real players in the market. And I will talk a little bit about that when we get to the euro. I'm going to show you what real players do in the market and how the price action looks. Okay, so then Holland says we see a base for a deal. A third bailout is out of the question, and there's not discussing debt relief. Okay, so Holland is saying the opposite of Merkel. Okay, most important person in Europe against probably the second most important country in Europe. Okay, you'll understand that. So very important, guys, when you read the newspapers, when you read anything, read between the lines. Okay, what are they trying to tell us? Where is the information? Okay, that's Greece. Let's move on. They're starting to become a little bit boring now. So let's move on and see what else in the news. Bank of England. Okay, nice article in the FT written by Mr. Fernando something Liano. Right, what he's saying is Bank of England strikes an upbeat note on productivity growth. So why am I pointing this out? Very important. Okay, the Bank of England's been constantly talking about this one word, which is a lack of productivity. In other words, they're saying that the average worker in the UK is not producing as much as he was pre-financial crisis. Okay, more important, what they're saying is that, in essence, it's all good and well creating jobs. It's all good and well people are working at McDonald's for minimum wage, right? But they're not going to be able to, in the long run, be a sustainable consumer. In other words, we're not going to get this strong recovery that people have been talking about. Okay. So what the Deputy Governor is going on about here is he's saying that there is something the Bank of England needs to pay attention to, and that is this lack of productivity. Because what happens is if we keep going on and keep growing the way we are, and we keep creating these jobs, more and more people getting work, more and more people start spending money. If productivity does not increase, in other words, supply does not increase, but demand increases as wages increase, right? Suddenly that's going to start creating inflation. Okay, because when there's a lack of supply against the demand, that starts to put prices higher or put pressure on prices to the upside. Okay, so that whole article is going on about we've got to be careful because whilst we're not seeing productivity, that doesn't mean we won't necessarily see inflation. Okay, bear in mind last week we saw 2.8, if you listen to Alex this week, we saw 2.8% wage growth over the course of June. Huge number, guys, absolutely phenomenal number. If that trend continues, right, what we're likely to see is we've got three hawks on the Bank of England, one being Mr. Wheel, okay, the other one being McCafferty, okay, however you spell his name, and the third one is Miss Kristen Forbes. Okay, those are the three members that are most likely to start voting for rate hikes sooner rather than later. Why? Because they're all talking about wages starting to pick up, and that'll ultimately lead to strong inflation. You all understand that? So why am I telling this as traders? Well, it's simple. Every month we've got a Bank of England meeting, okay? And after the Bank of England meeting, we've got a minute from the meeting, right? Now, after that very, very stellar wage growth, what you could very likely see in the minutes from the July meeting is the change of the 9-0 vote actually changes now back to a 7-2 vote, okay? However, where's the caveat here? Do you think I'm the only one that knows that information? Do you think I'm the only one that knows that there's roughly a 70% chance that we move from 9-0 to 7-2? No. Okay, smart money thinks about these things. So what do you think smart money is going to do 1 week, a few days going into the meeting or into the minutes? They're going to start positioning. Okay, so why am I telling you guys this? Well, it's simple. As traders, you have to be thinking ahead. Right? If you're looking at a chart and you're thinking, oh well, there's support here from 1960, you're thinking behind. You're behind the curve. As a trader, you want to make money, you have to be ahead. What is the market going to do today, tomorrow, and the next day? That's how you have to think. Okay, the game has changed, guys. Trading has evolved. Right? It's no longer a case of, oh, you buy the support, sell the resistance. It doesn't work like that. If it's obvious, everyone can see it. What's not so obvious is that potentially the Bank of England could change from a 9-0 to a 7-2. Okay, read that article, you'll get a few more ideas. Right, very interesting to see that John Cunliffe is one of the more neutral members of the board, so for him to come out and say something hawkish like that, it's interesting. Okay, it's interesting to see what another important member on the board is saying. Okay, let's move on. Let's talk about the retail sales very briefly. So Oh, the PMI, sorry. Okay, so European PMI, okay, remember, we continue to see this recovery story that Draghi's talking about. Okay, manufacturing, particularly in France, is now back above the 50 mark. So it's back into, expansionary territory. Okay, and then obviously Germany had a nice little beat as well. So all in all, guys, manufacturing in Europe picked up. Okay, expectation was a 0.3 to the upside beat, and services was a 0.8 to the upside beat. Okay, so again, Draghi can continue to strike this tone of, the recovery is actually ongoing and nice and robust and strong. Right. So why am I telling you this? Well, again, all right, there's a lot of talk that, German bunds, we're currently at 80 basis points, somewhere around there, 0.8%. Okay, there's a lot of talk of, when are these big institutions going to start stepping in? Right, where is the floor going to be on this pullback in the German bonds? Okay, what I would say is that so long as the data keeps improving, so long as we keep showing signs of growth, so long as we keep showing signs of inflation, all right, German 10-year bonds are going to struggle to rally, in other words, move back towards 60 basis points or lower, all right, in the near term. Okay, so just very quickly, remember, if I was to illustrate the trend for you, let me just quickly give it to you. Right now, the trend in the German bonds is we rallied at the beginning of the year. We then had the very quick sell-off move. Okay, the markets have now sort of bounced and been sold into. They've bounced and been sold into. Okay, so what we can see effectively is a market that's starting to show a little bit of downward, sideways action. Okay, so if you're someone who's a long-term trader looking for bonds to sort of continue the long-term uptrend, you're going to need to see the growth metric, the inflation metric start to turn. Okay, again, guys, it's so important you follow these things. Okay, it's so important you understand how these things evolve. Okay, that's effectively the PMIs and all I want to talk about. Let's move on and let's get to the fun stuff for today. Okay, so first up, let's talk about the Stocks 50 technical gap. So again, thanks Frederica for supplying us with your video. All right, just very briefly, let's go over the rules. Let's quickly do these rules. You guys can tell me the rules, seeing as you all listened so well yesterday. So, what's rule number 1? Freddie, what's rule number 1? Come on, nice and loud.
Oh my God.
Come on. Where do we put our bid?
The market, the position of the market.
Okay, good. So our order, okay, nice and high, guys. I'll show it to you on the ladder what I mean by that. So nice and high, well away from the market. You want to buy the gap open, okay, make sure you're nice and high so you don't have to fidget with that opening price as the auction's going on. Okay, step 2, we put our offers in before the open. Got that? Okay, excellent, well done. And then number 3 is?
Position of the market.
Okay, yeah. Okay, so you want to see where the position of the market is. You want to understand where the price is trading. Okay, but effectively we know that it's a gap. Okay, but step number 4 is one to look to fade any stops on the open. Okay, so effectively a cut and reverse. So important, guys. Yesterday was a fundamental gap. Monday morning open, we had news on the weekend. All right, the market fundamentally gapped. Today was a technical gap. Now, what I will say, as a rule of thumb, technical gaps tend to fill. As a rule of thumb, they tend to fill. Okay, so had you sold the open today looking for a fill of that gap and you lost money, I can almost sympathize with you. I can feel for you. However, here's the rule about fading the stops. Once you fade, okay, you're fading a technical gap for the gap to be filled. Okay, so once you actually hit that fade, the market should never ever go above the extreme price. You'll understand that. So once that stops go off, bang, you hit for the gap fill, and you start to go on sides, what do? We put our stop above the high of the day. You all got that? Okay, simple as that, guys. That's going to protect you from getting caught in the moment. Right. These rules are in place so that when, for instance, it opens and it goes blip, bop, bang, and you go nicely 6, 7, 8 ticks inside, and all of a sudden, you're thinking, yeah, gap's going to fill, I'm going to be 10 tick winner on the open, you're getting all excited, and you forget your rules, okay? All of a sudden the market goes bid, 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 and all you're thinking is, no, my gap's going to fill, and suddenly you're offside. And no, my gap's going to suddenly you're further offside, and further offside, and further offside. Okay, so that's why we put rules in place. Because had you been stopped once that previous high had been taken out, right, you would have come back to the logic and said, well, actually, hang on a sec, there's something bigger at play here. Okay, and that's why we use rules. Okay, so let's watch the video and see, and go through those rules one by one as it were to open. So Important thing to understand, the high price was 35.94, so let's just play it out. Okay, so very important, the high of yesterday was somewhere below here, okay, where that blue line is, so 35.94. That was the high of yesterday. As you can see, okay, there's our auction process, so we can see the market's about to gap on the open. So what we do is we put our bids nice and high up the page, so we don't have to worry about getting filled on the open. Okay, very important. See, so what you can see Freddie's doing, he's making the mistake again. So we said yesterday, we first put our bid in nice and high, okay, and then 10 seconds before, once that settles, that's when you put our offer in. Freddie, okay, so you made the mistake again today. First get that bid in, nice and high, Freddie, what are you doing? Okay, can you guys see the mistake he's making? It's so important he's making this mistake. Because what did I tell you yesterday? I told you, when I took this trade 3-4 years ago, I've made this mistake 4 times. Okay, in terms of P&L, it's probably cost me about £5,000. Those 4 times that I've made this mistake. So next time, Freddie, write there in your book, next time, where does our bid go? Put it up here. Okay, the reason you're putting your bid there, it's simple. You're looking and you can see it's going to gap very high and you're uncomfortable buying a very high price. Okay, but remember, the trade strategy is we're looking for stops on the open. Okay, so please guys, make sure you learn that rule. And then obviously the last 10 seconds, put those offers in. So let's see how this plays out. Okay, good Freddie, I like you got your offers in now. Okay, you're lucky to get filled at 16s if you got filled here, because you're not even sure that you'll get a fill. And bang. So let's quickly clear that. As you can see, so he bought 16s, he's out at 20s. Nice 4-tick winner. Okay, let's just go back and see if we can see some of the stops from the algorithms. Okay, so let's quickly play this. See where those stops come in. Okay, no stops yet guys. No, you got stops in the open, where the market's gone straight bid. So if we were to see something like this, flash, flash, that's our stops in place. So let's keep an eye on this and see where this goes to. Okay, let's see if we can find some stops here. Okay, a little bit of sell side action. No real stops. Okay, let's keep an eye on this. Okay, very strong bid in the market. You can see someone is literally buying the open. So let's see once those stops come in. Let's see what happens once those stop. Let's see what the price action looks like when the stops finally come in. Okay, 600 lot in the market. Note the size here, guys. Okay, 600 lot. So what do you think is going to happen when he gets lifted? Do you think that 45 lot's going to hold? So bang, we need to be looking to buy through 28. Bang, bang, bang. Hit the 8, hit the 8, hit the 8. Lift through him. Okay, guys, when size gets lifted, remember someone is buying the high price for a reason, because he's stopping out. Okay, you should get a little blip through here. Come on. Okay, again, he's being front run. He's being front run. So let's see how it plays when it gets through him. Come on, speed up. Okay, note the absorption here. So someone is obviously happy to get short here, but equally, someone is buying the market at the higher prices. Okay, I just want to fast forward and see what happens when we get through those 28s. Okay, hopefully we're not going to run out of video. Okay, unfortunately we are going to run out of video here. Okay, what I would say guys, make sure in terms of price action, okay, note, if you see what's happened here for the last 3 minutes, someone has bought effectively and sold 5,000 contracts. So 5,000 contracts has exchanged hands. But what's happened to price? Okay, so the market's open, it's rallied up, it's then pulled back, and all we've done is exchange contracts at the high of the day. Okay, so yes, there is a seller, but equally there's a buyer at higher prices. Right. So what you would expect to see, and I want you to go and look at this, is 24s to 30s. Either way we break, we should get a move in one or the other direction as the buyer or the seller wins the fight. In this case, I think the buyer won the fight, so once we took out those 96s, we had another move higher. You understand that? Okay. You've gotten a fundamental gap yesterday. You've gotten a technical gap today. 2 examples of how to make money in the first 2 seconds of the day. You all got that? All understand that? It's difficult to make money in this job. Okay, there's a couple of little tricks you have to learn in this job, and that is one of them. Right, get those rules in place, make sure you understand your own rules, and make sure you execute properly. Freddie, thanks for your video. Well done again. Okay, you made money again. Just make sure next time, where do we put that bid? Nice and high. Don't make the mistake again. Okay. Because what would have happened is you didn't get that bid, you would have been 3 short and very far off sides very quickly. Okay, let's move on. Let's talk about the US durable goods. So what does a rejection trade look like? I'm just going to get a chart up quickly and then we can go from there. Okay. So let's go through the data rejection trade. Right, now, first thing that's important to understand, number one, okay, ask yourself, what is nota bene, in other words, important data? Okay, that's what you have to ask yourself. What is market moving data? What is significant to the market? Okay, your data reversal or your data rejection trade or reversal, okay, will tend to come on important data. In other words, the market, there's a market participant waiting for key moving risk event type data to get out of the way before they start executing their work for the day. Okay, so once you understand that, step two is to look out for the, what can cause a data reversal. I will show you in what context can we get data reversal. Okay, in a minute I will answer that question for you. Step three is execution. Okay, you all got that down? Written, ready to go. Okay, so let's quickly address this. In what context? You get two contexts. One is in a trending market. Okay, and two is a flow-driven market. Okay, so what does it mean by that? Okay, three, there is another one. Okay, well, in fact, let's keep it to the two. So what do I mean by those two? Right, number one, if a market is trending very aggressively, day after day, okay, and you have a feeling or there's a reason for this very technical drive in the market, and we suddenly get a key piece of data which blips the market back up the page, okay, it's very, very likely that participants are going to use that data to initiate positions. You'll understand that. In other words, if I'm desperately all day, all I've watched is 60-minute candle after 60-minute candle after 60-minute downtrending all day, and I'm just desperately waiting for an opportunity to get short, okay, bang, that will be the opportunity. Okay, the example we're going to use, I'm going to show you the 10-year US, right? But if you look in the euro-dollar today, you will note that once the durable goods came out, the euro-dollar blipped up 30, 40 prices and instantly got hit back down. Okay, someone was waiting for that data just to initiate their shorts. Right. The second is in a flow-driven market. In other words, the example I'm going to show you is the US 10-year. And in fact, I'll get you the chart so we can actually have a look at it. So, what do I mean by a flow-driven market? Okay, this is the US 10-year from yesterday. Now, this could have been any market. Right. What I want you to understand here is the concept of what a flow-driven market looks like. Now, the first thing you need to have a look at is this is a 5-minute chart, by the way. Okay. Now, what you have to say to yourself is, if I were a seller on this day, what would it have felt like? Okay. Does anyone look at that chart starting from that green line and finishing at that green line? Does anyone look at that and think, well, actually, if I was a seller, this would have been pretty difficult today? Okay. The way I look at it is, the market opened, it sold off, it had a shallow bounce. It then, I wouldn't even call that a flag, but it then consolidated in the lower end of the day, the lower 25% of the range of the day. It then continued the trend. It then had a second shallow bounce and continued a consolidation type pattern. Okay, before then drifting lower into the close. So as a seller, this felt like a very comfortable trend-like day, where a market sold off, consolidated, drifted lower. As a buyer, what did this feel like? Okay, so what you do is you put yourself in the reverse. You say to yourself, let's say I was long the market somewhere over there. Okay, the market went down a little bit, so put me offside, made me feel a little bit, what's going on here? Why is this market not bouncing? But then it did bounce. It started to make me feel like, hang on a sec, maybe I've got the low here, maybe I'm understanding this market. And then it turned around again. But note how it turned around. Okay, that's a half an hour period where a little bit of selling, a little bit of buying, a little bit of selling, a little bit of buying, a little bit of selling, a little bit of buying. Okay, creating a lot of uncertainty as along. Then all of a sudden the market says to you, sorry sir, you're in trouble here. And it moves lower again. Okay, now you're suddenly off sides. Now you're starting to look at your P&L, you're starting to think, well, actually what's going on here? You know, this, it feels so heavy. But then, hang on a sec, the market says, I'll give you another bounce. It gives you an opportunity to average. But always ask yourself this. Had you bought somewhere around those prices and somewhere around that price, would you have been allowed out of an average? Simple answer is no. the market did not bounce sufficiently enough to allow you out of an average. And that's the clue. If you as a buyer, if you had been buying this market all day yesterday, you would have felt very, very frustrated as a buyer. You would have felt like, you know what, I kept buying this market all day long and it gave me no opportunities as a buyer. When you feel that, listen carefully, when you feel that in the market where you're on the one side of the market for most of the day and it doesn't seem to give you any opportunities, that is what we call a flow-driven market. Okay, now for the newer guys, you're going to see this in approximately 4 days' time. It's called month end. Okay. Month end is typically known for flow-driven markets, markets that move the one way throughout the course of the day. Okay. So if ever you feel that frustration, fuck, this market cannot move, it can't bounce, it can't give me a chance on the buy side the whole day, that's a flow-driven market. Okay. Now what a lot of traders do is they go and they get upset and they lose money and they come back the next day and they don't use that information. Okay, remember guys, when you take losses, if you sat yesterday buying that T-note the whole day, all right, and you took losses, you're paying for information. But most traders don't use that information. That information's simple. A market that keeps going down the whole day in a flow-driven environment is probably going to continue in that environment. That's the secret, guys. Okay, don't lose the lessons. When the market teaches you something, when the market frustrates you, don't lose the lesson the market's trying to teach you. Don't forget the information that you've just paid for. Because ultimately, it's that information that you're going to use to make money in the long run. Okay? So let's move back. Let's have a look how this daily reversal trades. So effectively, what I was leaning on, I was looking at this T-note yesterday, and all I saw was down, drift, drift, drift. So all I saw was a very flow-driven type day. And I said to myself, those flows are going to continue. And I said to myself, I expect them to continue once the risk event's out of the way. And that's why I was looking for shorts on the durable, or at least a reversal trade on the durable number. How does a reversal trade look? Let's draw it. Okay? So what does the pattern look like? Simple. All right? The market starts at a price. It blips up on data. In this case, durable goods was slightly weaker than expected. Okay, let's quickly get the number. So if I scroll down and I show you the durable goods, okay, there it is. So we had a 1.8 versus, or negative 1.8 versus negative 0.6. So a minus 1.2% beat. Okay, in terms of what's important to look at durable goods, I would say the headline number tends to be very skewed. Okay, so what I would always say is try and look towards the X transport number. Okay, that was a slight little miss of 0.1. But let's get back to the data. So how does a reversal trade look? Okay, the market blips up. It then sort of sits there, and you tend to see someone either absorbing or executing. Okay, now typically, think of yourself as a broker. Your job is to execute 10,000 contracts after the number. Okay? You're going to do this in the slyest way possible so you don't show the market your hand. All right? So anyone buying off this number, you hope they can buy a lot of your 10,000. But the minute they stop buying, in other words, the minute the algorithms start realizing that actually there's someone pretty big here selling the market, what are they going to do? They're going to stop buying and then they're going to start selling in front of you. Okay? And brokers know that. So that's why they take as much of the buy side action they can and then they execute a market and they just get the order done. Okay? So what we're going to look at when we watch this ladder is we're going to see how this plays out. We can see how this little game plays out from the brokers. Where we as traders can make money, well, one, if you're good at watching this kind of price action, you can get involved. But more importantly, once we take up that starting price, right, remember, a lot of people would have got long off the number, and we should see some stops to the downside. Okay, so 2 trade opportunities to get involved there. Let's see how it plays out. And by the way, guys, you see this quite often. Okay, it's a very, very unique pattern to NFP, so non-farm payrolls, you tend to see this quite a bit. Okay, so what markets we got? This is the one we're looking at, the one in the middle. That's the US 10-year. Okay, so we want to make sure we trade the product. So as you can see, the market starts at 16.5 pre-number. Note the ladder. I've cleaned my ladder up. Okay, why have I cleaned my ladder? Simply so that I can effectively see what the volume, or I can see the absorption a little bit easier. Okay, so let's move this on a little bit. Okay. Okay, so let's start it again and see how this works. Come on. Okay, so the number's about to come out. And bang, remember we had a minus 1.2% miss. Starting price is 15 and a halves. Okay. So So the number's out. We've got the miss. The algorithms are buying. Buy. And let's see if we can find out where that absorption comes in. So note, we can see someone taking a few there. We can see someone taking a few there. Okay, let me just erase it so you can see the numbers. Okay, so all of a sudden, over these three prices, we've seen 5,000 contracts executed. Okay, so let's watch how this plays out. Note how that's running up. So someone's executing 18.5s and 19. Now remember, I've got 10,000 contracts as a seller I need to execute. Okay, how's he doing it right now? Well, right now, he can feel there's a buyer. You can see there's a buyer because someone's lifting the market up. Okay, so this seller is happy to let the buyer keep buying from him. But let's see what happens once we get back below that 18 or that 18 price, i.e. where that buyer is trying to buy. So note, we're now up to 6,000 contracts, 6,500 contracts, okay, almost 7,000 contracts executed over one price. Okay, so over these two prices, suddenly we've almost done 10,000 contracts. 10,000 contracts in the space of a minute. Okay, again, how committed is this buyer to buying these 19.5s? Okay, lack of commitment. So again, remember, we want to see now, we can see there's a seller, we can see there's a buyer, but what we need to see is whether or not the seller is actually going to start selling to the market. Okay, note, no volume trading at 19.5s. Okay, again, 11,000 contracts over two prices, so we can see the absorption. Let's see how this works when this market now turns. In other words, when the seller starts to execute at market. Okay, so we can see the seller going. He's just sold 600 to the market. What did the buyer do? He said, thank you, I'll take some more. All right, and the buyer then lifts the market again. So we've got two-way trades here. We've got a buyer and we've got a seller. Who's going to win this battle? Okay, very important. You can see I'm short there. Where am I stopping out? Well, it's simple. I know that buyer is not committed to lifting 19.5. So he lifts the 19.5s and he takes the 20 bids. I'll be out. Because then you know what? The buyer is quite strong. And I'm 100% wrong in my interpretation of a reversal trade. Okay, so note again, what's the commitment at this price? So yeah, we do 12,000 contracts. The buyer is very happy to execute at these two prices. But is he happy to execute at 19.5s? No. So it's giving us a clue, guys. Why is this buyer so strong at 18.5s and 19s, but not strong at the high price? Why is he not buying the market up? Okay, again, fifth little test. No commitment. Okay, so there all of a sudden, he lifts the price. So the buyer finally goes to the market. Right? And again, what happens to the offer? So suddenly now the buyer's buying the 19.5s, and that seller, okay, suddenly sitting there. So all of a sudden, we get out of this trade. This trade's no longer working. Okay, but let's keep going. Let's see what happens now. Okay, let's move this on a little bit. So again, note, another 4,000 contracts trade. Okay, so now over a course of almost, what, 4 prices, we've almost done 20,000 contracts. Okay, and guys, this is all in the space of 20 minutes. Okay, let's see how this plays out. Let's move this on a little bit quicker. Okay, reversal trades, by the way, do tend to happen a little bit faster than this. Okay, so again, remember we said our important price is 18s. So note now, it's the first time in 3 minutes we've seen someone go 3 consecutive offers in a row. Okay, where's our buyer? What did we say? 18s was the key price. Let's see how it responds below 18s. Okay, can you see that buyer anymore? Buyer's gone now. So a minute ago, someone was buying every price, executing at any price, just making sure he gets filled. Now all of a sudden the seller comes in, sells 4 prices in a row, and the buyer's gone. Let's see how the price changes. Let's see how the market responds below these 18s. Okay, that's where the buyer was, started his buying program. Okay, come on. Let's keep watching this. Let's see how this plays out. Okay, again, buyer's still there. Right, buyer's still happy to lift 18.5s, 19. But we know now that 18s is the key. We know that is the absolute key price. Takes 18s and then buys in a spot of trouble. Okay, takes 18s, reloads the offer. Okay, we should see 17.5s go at market, 17 at market, 16.5 at market, 16s. Okay, there's a strong seller in the market now. Very intent on executing short side trades. Alright, I'm just going to fast forward this a little bit. Okay, so 17s trade. Alright, let's move it on a little bit. 16.5s trade. Okay, remember our starting price was 15.5. So let's see the reaction we get at 15.5. Note the offer, guys. Market's not bouncing now. So there's the 15.5s. Let's see how the market responds once it gets below the low. So what we're expecting to see below this price, the starting price, is a little bit of stops. Okay, let's get to that point. If I can finish this trade off for you. Okay, already took it. Let's get a little bit back. Okay, let's see what happens here. Okay, so anyone long with the durable goods will literally have their stop below the 15.5s. Come on. Try and get frame ahead. Oh, go back. Okay, so let's watch how this works. And offer, offer. Okay, and over the course of this now, I'll just fast forward this quickly so I can just summarize this for you. You'll see over the course of this, comes back to 15.5s, comes back to 16s, okay, but eventually did continue lower towards the 12s, and then eventually I think it went all the way down to the 9s. See if we can get this all the way. Okay, you guys got that? That's a data reversal trade. What I will say in terms of that, right, the time on reversal data trade tends to be a little bit quicker than that. Okay, the reason it was so slow today was because there was a particularly big buyer there. You could see the buyer, but you could also see the seller. When you see those battles going on, it's the outcome of the battle, it's the winner of the battle that's going to ultimately take the market up or down. Any questions about that reversal data trade? Right. When we do the NFP rundown for next month, I will show you the pattern, how it looks in FOS time. Okay, and then you can get a better feel for it. So that's a data reversal trade. Let's then move on. I want to quickly just go through one or two things with you. I'm just going to talk about the kiss of death. We're going to revisit that trade. Okay, we spoke about this yesterday. Okay, so the first thing I wanted to point out was this chart here. All right, we spoke about this once, twice, 3 times. Now this is the US 10-year. Okay, the market then broke above that area, as you can see over there. It broke through this sort of a longer-term trend line. Okay, this is a monthly long-term trend line. Right. It then got up to this 2.5% yield, and it's now come back for the first retest of this yield. So I just wanted to get you this chart up so you can see where that trend line comes from, which I showed you yesterday. And more importantly is what's happening on a shorter term time scale. Okay, so effectively there's the retest. And what we've done yesterday was we had a very, very strong rejection type day. Okay, remember we said the whole point of a kiss of death is that this move here gets anyone long out of their trades. So all the longs are gone. That's what that move creates. It creates a washout. It comes and retests the important reference point in the market and springboards straight back up the page. Okay. Now, what you tend to find with these kiss of death, and it's so important, it's the key to this trade. Okay. If everyone that was long is now stopped out, what do you think is going to happen when the market turns around and starts to go where they thought it was going to go? They're all going to do what? They're all going to jump straight back in. Okay. And this is the key part of the trade. The kiss of death should very quickly accelerate back up to you, simply because if everyone, in other words, if that was a squeeze in the market, then everyone that stopped out should now jump back quite aggressively, and that's what will take the market back to this 2.5% very fast. Okay, so time, and you heard Dan Gramser talk about this, time is so crucial on certain setups. Okay, use it to your benefit. Right, so let's talk about what happened today. Simply, we got to that 2.4% we've been talking about. Okay, what I do want to see is, do we close above or below 2.4%? We close above, well actually, the price action is starting to suggest a pretty aggressive bull type move, where the buyers are very quickly getting on this. This is a yield chart, okay, so the inverse is the price. Right. More important, what I do want to see this week is the retest of 2.5%. That'll confirm the kiss of death. Then, going forward, and we will look at this trade back on Monday again, we need to see this market springboard above 2.5%. Okay. This is a trade setup I will show you down the line. You get these kiss of deaths quite often. The reason I'm pointing this out, particularly to Futex traders, okay, is because you have to ask yourself, what will the markets do as a result of the US 10-year taking out the highest yield of 2015? Okay? The newspapers, the FT, remember I spoke about the forward thinking. The FT is going to come out with an article the day we springboard, and they're going to say, US bond yields rally on the back of interest rate expectations for December and risk off and blah. They're going to come out with all sorts of wonderful things. Okay? What they're not going to tell you is that, actually, hang on a sec, the reason the market took out the 2.5% is because technically everyone was long. That's what they're not going to tell you. What they're also not going to tell you is what is the implication on the equities, on the currencies, if yields in the US rise above 2.5% on a 10-year time frame. Okay, so your job tonight is to go and interpret what are you going to do when the US 10-year gets above 2.5%. How is it going to impact you? Okay, that's the important thing, guys. That's what I want to discuss with you with regards to that. Now, the last thing I'm going to do for today, and I want to just finish off with this, is I'm going to show you what a sucker trade is. Okay, for the newer guys, this is a good little exercise for you, because I'm going to show you a mistake all retail traders make. Okay, so the first thing I want to talk about is effectively the euro dollar over the Dijsselbloem comment. Put on. Okay, just 1 sec. Yeah, I'll put it on. Okay, just 1 sec, guys. I'm just going to quickly put this on. Excellent. Okay, so for everyone on Periscope, welcome. Okay, for everyone in here, I want to show you something very, very interesting. Please take a few mental notes here. Okay, so effectively, this is the euro-dollar currency pair. Okay. Now, over the course of the last couple of weeks, if you were to look at, in fact, let me get this chart up, and we can actually. Where is this? Just bear with me for 1 second, guys. I just want to get this up. Okay. So effectively, this has been the trend for almost the last 3 weeks in the euro. As you can see, the market's been making a low, and then a high, and then a low, and then a something there, and then a high, and then a low, okay, and then like another something there. So effectively, if I was to draw a moving average, it'll look something like that. So in terms of price, what are we doing? We're neither trending, not up, not down. We're going sideways. Okay, and all of a sudden, Dijsselbloem comes out on Monday afternoon and says to us, actually, you know, we're going to give Greece a deal. You know, things are looking very positive. Okay, and every single retail trader does what? They all go and suddenly buy the market up. Okay, and we can see it in this little red circle. So what you see here is the beginning of Dijsselbloem's comment, and the euro suddenly catches a huge bid, a very strong bid. Okay, now on paper you can understand why retail sales buy euro on a positive comment about euro. Okay, because hey, Europe's saved, end of the world, okay? We don't need to worry anymore. Everyone suddenly buys the euro. What people are forgetting is that the euro, at the moment, is being utilized as a funding currency. In other words, simple terms, if I can borrow money in Europe at 25 basis points, okay, and I can invest it in the United States at 1% or at 2.5%, okay, so I borrow at 25 basis points and I invest in a US 10-year bond at 2.5%, okay, I'm effectively utilizing a currency with low interest rates. I'm using it as what they say a carry type trade. Okay, so right now the euro is being utilized as a funding currency. In other words, in times of risk off, in times of panic, the euro is being bought as a safe haven currency. Okay, and a lot of people forgot that. A lot of people forgot that the reason the euro was showing that slight little uptrend over the last couple of weeks is because of the Greece crisis. Okay, so people were buying euros as a safety against as some sort of a Greece type panic move. Okay, now again, I know that's going to spark a lot of sort of controversy, and a lot of people say, no, that's wrong, blah, blah, blah. Okay, but what I want to show you is what the retail market did and how we can take advantage. All right, so first thing is first, that was our very strong bid. What do we know? When the whole retail market buys in a Dijsselbloem comment, the position of the market is long. Okay, so we had a long position in the market. So the first thing, and you need to make a reference point, whenever you have a key data, an NFP, an FOMC, make sure you reference the high and low price of that data piece. Okay, so the starting point of Dijsselbloem is somewhere around there. Okay, now what you have to ask yourself is, why, if this was such a positive with the euro, why on earth are we back at that starting price? That was the clue, guys. That was the important clue. Now let's move this on. I want to speed this up, and I want to just show you what the whole point of this message is. So we got below that starting price, okay, somewhere over there. The market then continued to sell off and broke below that 1, 2, 3, 4 trend line. Okay. Now note, let's have a look what it did over the course of today. Okay. So this is today's chart, right? That's effectively the sell below the trend line, and the market kind of in the Asian session went sideways. Suddenly Europe opened and the market started. Okay. Now remember that little trick I showed you in the beginning, which was put yourself in the boots of a long position. Imagine you were on IG index and you were long on the Dijsselbloem comments, and suddenly it comes down to this little level that you have and it bounces. Okay? Is that going to let you out of an average? Okay? Market consolidates and then it goes again. Is that going to let you out of your average? No. Okay? And then it moves again. Now imagine if you were long in this market, what would have happened to you over the course of today? You would have lost a lot of money. Okay, so remember what I said to you, when a market moves in one direction without allowing the other side to participate, we call that a flow-driven market. Now what are our expectations the day after a flow-driven market? And this is something I want you all to make a note of. This is the trade opportunity that exists in this market, which happens to be the euro-dollar. It's simple. When a market is showing, flow-driven type environment, okay, you want to be selling with the trend. Okay, so any kind of a bounce, look to sell into it. Why? Not because I'm telling you, not because the charts are telling you, but because there's institutional flow in the market. Okay, and they're not going to just do one day of sell side action. They're not going to just do 50,000 contracts. There's a reason the institutions step into a market yesterday. Okay, and that reason is because they've been given the green light on Greece, pardon the pun. Okay? So once that signal's been given, that's when you guys need to get going with the flows. Okay, so when you see institutional flows, make sure you print these things off, put them in your playbook. Okay, because these institutional flow type trades are going to be very lucrative in the long run. Now, to finish off, I will show you this trade tomorrow. I will show you how it plays out. In terms of entry points, okay, that's your job. It's your job to go and understand how are you going to execute the short tomorrow. But what I can tell you is that from a probability perspective, okay, so from a back test perspective, the probability of testing tomorrow's low is 80%. The probability of extending on tomorrow's low is 68%. Okay. The odds are very much in the favor of being a short on any kind of a pullback. Okay. Barring, of course, if there's any sort of change to Greece or anything along those lines. You all understand that? Okay. I've just got one or two other charts I'm just going to effectively run through, and I'll just show you what it looks like on a daily chart. So effectively the daily chart just looks like this. Okay, so that's the daily after today. Okay, so again, if you're looking for levels to get involved, well, yeah, that sticks out like a sore thumb, that little double bottom. Okay, but what's important for me is that I'm not looking tomorrow to go and say I want to buy there and buy there and buy there and buy there and buy there. What I'm looking to do is I understand there's flow in the market, I understand there's institutions in the market, and I'm going to partake with those institutions. I'm not going to stand in the way of the flow. Okay, what I will say for you guys, I'm going to give you a free little tip here tonight. I'm going to give you the Holy Grail. Okay, you know what it is? Back in March, February, March, okay, we saw the same institutional flow in the euro-dollar currency pair. I'm going to take one more step and I'm going to show you what the chart looks like. Bear with me for 2 more minutes, guys. I know this is long, but just keep with me for 2 more minutes. Okay. So what you've got here, in essence, okay, this little pink line is the euro-dollar currency. And then these 3 lines below here are European equities. You've seen this chart before. And that big solid red line is the S&P index. Okay, so what I'm trying to show you is that when European equities outperform the US because of the QE play, the result in the euro is a very aggressive sell-off. Okay, so note, back in February or January 22nd, when ECB's Draghi announced quantitative easing, we saw the European equities completely outperform, okay, the euro. In other words, at the beginning of the year, European equities were 10% underperforming the S&P. They raised that entire 10%, and at the same time, we saw that euro move from 110 all the way down to 104.50. Okay, for the second time this year, we've started to see outperformance in the European equities, and as a result, the euro started to sell off. Do you understand that? So if you as a trader want to understand what your trade edge is tomorrow, just go back to February. Go and have a look how those institutions transacted in February. Because do you think those very institutions that did that trade back in February are going to do anything different tomorrow? Simple answer is no, guys. There's your homework for tonight. Make sure you take advantage of this. Okay, tomorrow is day 2 of the euro-dollar sell-off. Right. Any questions, guys? Okay, so to finish off, let's get back to our page and let's wrap up. All right, to finish off, quiz question. What trade strategy do we use when institutions step in? In other words, in your playbook, one page, you need to have an institution step in trade opportunity. Okay, and it's simple. When you get a flow-driven market in one direction or the other, the very next day you're looking to execute with the flows. Your first target is the previous day's low, but more importantly is the extension of that day's low. Implement that into your strategy when you get flow-driven markets, and you will be a successful trader. Okay? Any questions, guys? Excellent. Thanks for your time. Have a good afternoon.